Welcome to this explainer. Today we're diving into the absolute machinery behind one of the most recognizable events in all of business, the initial public offering. We all see the confetti, we see the smiling executives, but today we're breaking down the exact 18-month gauntlet required to take a private company public.
We've all seen those celebratory ticker symbols flashing on TV, right? But honestly, the stark reality is best captured by this industry truth. The bell rings in about 30 seconds. The process that got you there takes 18 months. It's a massive, expensive, and deeply bureaucratic marathon that most companies only ever endure once.
Okay, let's map out this chronological gauntlet. We've got 6 distinct steps to get through: deciding to go public, hiring the underwriters, the S-1 filing, the roadshow, pricing the deal, and finally, the opening bell and beyond. Let's get into it.
So before we hit the obstacle course, let's quickly strip away the jargon. What actually is an IPO? Well, it's exactly what it sounds like. A private company, one owned by founders and venture capitalists, finally sells shares to the general public for the very first time. The company gets a massive influx of cash, early investors get a chance to cash out and gain liquidity, and we, the public, finally get access. Simple in theory, right? But man, it is incredibly complex in execution.
All right, step 1. Deciding to go public.
This whole thing kicks off internally with a huge question. Are you actually ready for intense public scrutiny? Because once you go public, your internal secrets are suddenly public record. To even be considered a viable candidate for an IPO, a company typically needs 2 to 3 years of pristine, fully audited financial records. Now, the law doesn't strictly mandate that exact time frame, but the SEC and the market, they absolutely expect it. If your historical track record is a mess, there is no way you're convincing anyone to buy your shares. You literally have to open your books to the world.
Moving right along to step 2, hiring the underwriters. This is where you bring in the major investment banks to shoulder the heavy risk. And the sheer scale of the underwriter's fee is kind of staggering. They typically charge between 3 and 7% of the total IPO proceeds just for buying the shares from the company and then flipping them to the public. To put that in perspective, on a $1 billion offering, that percentage means $30 to $70 million is skimmed right off the top. Naturally, banks fiercely pitch for this highly lucrative business. They'll often form these massive syndicates to distribute the shares globally, with the lead bank taking the lion's share of the cut.
Okay, step 3, the S-1 filing.
This document is basically the ultimate comprehensive self-portrait submitted to the SEC. We are talking hundreds of pages covering everything: business models, executive pay, who owns what, but the wildest part, the mandatory risk factors section. The law essentially forces a company to expose its deepest vulnerabilities. We're talking competitors, regulatory threats, key person dependency, macroeconomic exposure, litigation, the whole shebang. Why? Because if you fail to disclose a risk and it actually happens later, you're looking at massive legal liability. So companies are highly incentivized to list literally everything. It reads like a completely grim catalog of every single bad thing that could conceivably wipe out the business.
And don't think this is a quick submit and wait for approval kind of deal. Filing the S-1 kicks off a grueling, multi-round back and forth. The SEC combs through it, sends back formal comment letters packed with highly detailed questions, and the company scrambles to provide clarifications. This stance can easily eat up weeks or even months. Just to be clear, though, the SEC isn't judging if the company is actually a good investment. They leave that up to the market. They just want to guarantee total, uncompromised transparency.
Next up is step 4, the roadshow.
So while the SEC is busy scrutinizing the paperwork, executives, usually the CEO and CFO, literally hit the road. They embark on this tightly controlled 2-week sprint across major financial hubs to pitch institutional investors, your mutual funds, pension funds, hedge funds. But here's the crucial thing: they aren't closing deals on the spot. In fact, it's highly regulated. They can't say a single word that isn't already meticulously documented in that S-1 filing. Their goal is purely to generate indications of interest to gauge demand. Basically, they're just testing the waters to see which of these heavy hitters will actually step up and anchor the offering.
Which brings us to step 5, pricing the deal.
The night before the big day, all that exhausting preparation finally meets the market's judgment. Execs and bankers lock themselves in a room to set the final offering price per share, based entirely on that roadshow demand they just finished measuring. And there's a really vital contrast here that trips up a lot of observers: the offering price versus the opening price. The offering price? That's set in private by the banks. It's the VIP price for early institutional investors. But the opening price, that is determined in public by whatever the wild, open market decides to trade it at when the doors open to everyone else the next morning.
And this sets up a totally fascinating irony about IPOs. If the stock pops on opening day, the headlines celebrate it, but the company's finance team quietly notes the offering was underpriced. Think about it. If that opening price rockets past the offering price, the media throws a party for a successful IPO. But internally, the company realizes they just sold their shares way too cheaply. That whole pop is literally millions of dollars left on the table that could have funded the business, but instead went straight into the pockets of institutional investors who bought early and immediately sold into the hype.
Finally, Step 6, the opening bell and beyond.
This is it, the absolute climax of the gauntlet. But honestly, despite the incredible fanfare you see on the news, the actual 30-second ceremony is incredibly brief. And here's a fun fact. By the time the executives are up there smiling and waving at the cameras at the podium, the stock is already actively trading on the market. The ceremony is just an acknowledgement, a well-earned photo op, really, not the actual initiation of trading.
But the financial machinery definitely doesn't stop just because the confetti falls. Early investors, insiders, employees, they all face a mandatory lockup period. We're talking 90 to 180 days where they legally cannot sell their shares. This is essentially a pressure valve. It's designed to prevent a massive flood of supply from hitting the market and completely crashing the stock right out of the gate. Only after that lockup expires does the market fully absorb whatever those insiders decide to liquidate.
So, stepping back and looking at this entire chronological gauntlet, from the initial decision at month 0 to hiring underwriters at month 3, dropping that massive S1 at month 9, surviving the roadshow at month 17, and finally pricing the deal at month 18, it's a lot. You really start to appreciate the sheer, exhausting marathon required to transform a private entity into a heavily scrutinized public fixture.
Which leaves us with one final provocative question. Knowing this grueling reality, the 18 months of exhausting prep, giving up $30 to $70 million in fees, and entering a perpetual cycle of punishing quarterly earnings reports, is the 30-second glory of ringing that bell actually worth the permanent public scrutiny? It's a heavy question every successful private company eventually has to answer. Thanks so much for joining me in this explainer, and I really hope this structured dive fundamentally changes how you view the next big IPO.